It's time to consider your options. I'm talking puts, calls, strikes, expiries. If all that sounds like market jargon you couldn't possibly get your head around, think again. That's why we're here, and a lot has changed since the first time a basic options contract was traded. That was on olive presses in ancient Greece. Olives want to take this position in the ever-expanding market, but don't know where to start. Yahoo Finance's Options 101 caught up with the people who do to give you the information that you need. Take a listen. Selecting the right option strategy can be a daunting task, but don't fear. We're going to be breaking down which option trades are best given the current market environment in today's installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. And joining us here to discuss is Sean McLaughlin, All-Star Charts Chief Options Strategist. Sean, thank you for coming here today. I want to show the viewers at home the Wi-Fi Interactive, and hopefully you can see this too. I've been showing this screen all week. We have calls and puts. You can go long a call, and that gives you the right to buy a stock. You can also short it. That gives you the obligation to sell it, and vice versa. But what I want the viewers to see is a quadrant system that you've come up with to help you find the right options in the current market environment. We have a scale going up and down of bullish to bearish, and then from left to right, low volatility to high volatility. And we've put one example of what you can do in these different quadrants, but there are many more strategies. Could you just kind of break this down for us?
Sure. Hi, Jared. Thanks for having me. And what we're looking at here is just a sample of ideas that one can do based on the implied volatility environment that we are in currently. So I've seen the episodes you guys have done so far this week. You're doing an excellent job of covering a lot of the basics and options. The next step when you're about to put an options trade on is you don't want to just buy a call if you're bullish or buy a put if you're bearish. You want to take implied volatility into consideration to stack the edges in your favor. Because what happens is, in a high implied volatility environment, you are going to pay a higher premium, for example, if you're buying just a simple call, right? And if you're paying a higher premium, that makes it harder for you to earn an acceptable return if you get that trade right. On the flip side, if volatility is if volatility is low, then premiums are very cheap, and you don't want to be doing credit spreads. You don't want to be selling strangles, things that bring in premium, because you're not getting paid enough to compensate for the risk that might happen if a directional move happens in the wrong way or if volatility were to rise. So knowing the volatility environment is key to selecting the strategy you want to use to maximize your odds of success.
All right, and the VIX has been pretty low lately, at least on the indices. We've seen some pretty low implied volatility, but I want to break down a couple trades on the Wi-Fi Interactive here. We're taking a look at Mosaic, that's ticker MOS, and you're looking to buy the $30 put with an expiry in June of 21 this year, and we have a profit and loss chart. Could you kind of break this down and how you're thinking about it and how that ties into what you were just describing?
Sure. Well, this is a trade that doesn't come along very often. Typically, when a stock is breaking support and getting to lower levels or the lowest levels it's been in a while, you tend to see people, hedgers, people who are long, who are worried about the position, they tend to use the options market to insure against a large loss. So they'll purchase puts to protect their long position. And when they're purchasing puts, that drives the premiums of options up. But in this case, in Mosaic, right now, at least the time we put this trade on yesterday, the implied volatility in these puts were very cheap, the cheapest it's been in for most of the past year. And so we saw an opportunity where the analysts or the analysis that we've done here at All-Star Charts, we think that Mosaic, if it follows through on the downside, could trade as low as $23 over the next couple of months. So we saw that the June 30 puts were trading for $2 a contract. If Mosaic gets down to 23 before June expiration, those puts will be worth at least $7. That's what the intrinsic value will be at that point. Then we're looking at least a 3x return on our $2 investment, which is what we paid for those puts yesterday.
That seems quite attractive. Great risk reward. We have time for one more, so I want to get quickly to this next trade, which is Lululemon. You're doing a bear put spread, and just quickly for the viewers here, a bear put spread is when an investor purchases a put option while selling the same number of puts at a lower strike price on the same stock, and that's with the same expiration. So here we're buying the 420 puts and selling the 380 puts with an expiry of April 19 for Lulu. What do you think about this? Break it down for us, please.
Well, With the Mosaic trade, we just simply bought puts, right?
Yes.
In this case, we're buying a put spread, and there's two reasons why we did a put spread. Number one, the implied volatility in Lululemon options was a little bit more elevated, so it was more expensive to just buy puts in volatility terms. Also, the fact that it's a nearly $400 priced stock means that options just in absolute terms are more expensive. So by creating a spread, by buying one put and selling the further out of the money put, we lower our cost of participation, we increase our odds of success. And if Lululemon can't hold the levels that it's at right now, or I'm sorry, if it can stay below the levels where it recently was, we think that there's a failed breakout in play here in Lululemon. We think there's a lot more downside to go, and we're looking at maybe 390, 380 over the next 4 months.
All right. Really appreciate you stopping by here for Options 101 1 week. Sean McLaughlin of All Star Charts. Stick around, all your market coverage when we return. Many investors look for ways to diversify their portfolios, and one way is through options. Stock options are financial contracts that grant the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified time frame. Now, option investing has surged since the pandemic, with the retail share of options trading is rising from 35% at the end of 2019 to 48% just 6 months later, and that number is declining from its peak, sitting around at 42% right now. All of this data compiled by the New York Stock Exchange, by the way. But despite the rise in popularity, we're posing this question: is options trading for all investors? Does it belong in your portfolio? And here to help answer that question is Jim Struger, Kineo Capital Managing Partner. And this is part of Yahoo Finance's Option 101 Theme Week, sponsored by Tasty Trade. And Jim, we've been throwing some definitions out here, and we want to talk about everything, but just an opening line to our viewers.
One would be, if you get into options, number one, it requires a certain degree of focus and activity, because options expire all the time. And the other would be, understand your risk. Before you enter into any position, structure it as defined risk if you're brand new to these markets, but most importantly, understand what that risk is, what it looks like for various outcomes.
Great. Manage your risks, my number one mantra in trading. So let's get to this. Investing in options, these are some decisions and things that you'll have to think about before getting into the trade, including the underlying stock. And I put S in parentheses because you might have multiple stocks involved in the trade, but we can go through the directional bias, the strategy. Just talk to us about some of these things, some of the considerations that investors should have for their portfolio.
Sure. One consideration, you have directional bias. Is this a directional trade? Are you coming in, making a directional decision, buying calls, buying puts outright? Or is this a trade where you're seeking to take advantage of implied volatility being elevated, where you're short vega or short volatility and extracting premium from the market?
All right, we're throwing around a lot of inside baseball terms here, and that's fine because options involves a lot of this, and we want to break it down. So when you're talking about implied volatility, this is the amount of volatility that we're expected, that the options market is saying, we expect the underlying stock to move by this much. And how does that factor into your determination of what to buy an option price at?
You want to understand where implied volatility is relative to itself, and then also realized volatility, which is actually the volatility that's realized looking back over the course of time. Quick example, Microsoft reports after the close today.
Yes.
Options that expire this week are twice the implied volatility that they would normally be. The market expects a fair amount of volatility on earnings, even though it is Microsoft. That's something any option trader needs to understand before they enter a trade.
Great example, and we're going to get to our next page. Just want to point out that we have to consider expiration dates and strike prices. And let's give an example. Here's Tesla, where we have an options chart, profit and loss, and this is for a Tesla call at the strike price of 210, expiring the monthly expirations on March 15th. So just kind of break down this trade for us.
Sure. Tesla reported last week, unspectacular earnings report. They're overproducing. They've taken down the cost of their cars. Doesn't look great. Stock's down 30% over the last month. You've got people like Kathy Wood, who runs ARK, coming in buying $150 million worth of Tesla. If you want to express a long directional view in Tesla right here, implied volatility is in the right place for that because it's as low as it's been in 5 years. So it's about 40%. You really won't find it lower. So if you're paying up for premium, whether it be calls or puts, a good time to do it. In this case, we're talking about going out to March, buying the 210 strike call outright For that long directional exposure, break even's about 11% higher from here. But again, stock down 30% over the last month.
All right, great. And we want to get to another example. This one involves a covered call. This is where an investor sells a call option at a set price and expiration date on a stock that the seller owns in an equivalent amount. So key there is that you already own the stock. And the example we're showing here is NVIDIA, where we have a covered call option at the 700 strike price expiring February 23rd. That's a weekly. Just kind of break down this trade for us.
Sure. Important point here is that the statistical edge in option markets is on the side of the seller, right? So here you have NVIDIA, they're going to report on the 21st of February. We're using the Feb 23 expiration. We want to sell the 700 strike call. It creates a situation where if the stock happens to be above 700 at expiration, it's going to be a 13% total return over the 3 weeks to that expiration. If the stock is below 700, we just pocket that premium. It's about 1.5%. So in a lot of ways, it's a win-win if you're willing to sell NVIDIA stock up another 13% 3 weeks from now.
All right, put quite well, and thank you for your time here, Jim Struger. Appreciate your insights. Investors looking for bullish strategies have several avenues to reach their end goals. We're digging into those strategies via the options trade in the latest installment of Yahoo Finance's Options 101 Theme Week, sponsored by Tasty Trade. And joining us here to discuss is Jessica Inskip. She is the Options Play Director and Education Product Liaison. And let's just jump into this. We got 3 different scenarios here. So we're going to take long a stock, and we're talking about risk reward because in trading you want to have a stop or you want to have some kind of management tool there. And so we're going to take a long stock view, long call option, and then long covered call option and compare them. So let's begin with long stock, and I'm going to let you set this up.
Absolutely. So especially for my beginner options traders who are out there who've never traded before, or any type of trader, we have to focus on risk versus reward. So whenever we're buying a stock, the most that we can lose is the most that we spend, right? But when we're trading, we always have a price target in mind. And these are very essential components when we talk about options. We just add that layer of complexity because it's a derivative of more than just the underlying security. Yes. We've got time and implied volatility as well. So in this scenario, we're just assuming this hypothetical long stock is we're buying at the current market price of $100. We have a price target of $110, looking to make $10, which means our break even, or the most that we can lose in this scenario, is the amount of capital that we spent.
Which is all of it, but
yeah,
yes.
Exactly.
All right, now let's get to another scenario here. Here we go, long call option. Similar, but break this down, how the call differentiates the risk reward.
Absolutely. So same thing. It's important to know that we have a price target in mind. So assuming that we still have that same 110 price target, but now we're buying the call contract for 5, that means that we've got actually I believe this was moved around. I apologize. Yeah. This would be a 105 break even right here is what this is, because we would have a higher break-even price because there's a cost.
I got you.
So if we at the current market price is 100, we'll just say, well, we'll correct it right here.
Thank you.
This is 105. Now we're spending, this is a risk to reward of really, we can only make 50%. That's not very good. This is actually a poor scenario. Yeah. And I think one of the biggest risks of people going into options is they're going to start by buying calls. And if we're buying this call for 5, what you don't realize is that this is $5 from that 100 price is something you have to overcome before you actually become profitable. And that's assuming at expiration, but that's why those other factors are important. And the risk of starting out with options this way, it's important to know how pricing is really comprised.
Yeah, and price, so all your premium can go out the window. That's just time decay right there.
Absolutely.
So let's, instead of buying this option, let's look at another scenario here. And here we have a covered call. And first, we're going to give you the definition. Investor sells a call option at a set price and expiration date on a stock that the seller owns, that's very important, in an equivalent amount. So I have to own the stock, and then I can sell a call above the current price. And here's what that looks like.
Yeah, and I see where the issue came up. It's on the previous slide. This one's 97.
Got you. We're gonna
I
fix
apologize for that. But so we'll say this one's 97. So here's the difference though, and I'm glad we can write it down.
Yeah.
Now we're receiving that $3 premium. So in comparison to that 100, we've now reduced our risk exposure because we're receiving upfront. Exactly. So if this line here represents owning the underlying security.
Right.
have the same substantial loss potential because the most that I can lose is what I can spend. I own a stock at this point. I'm selling the covered call, so therefore I'm bullish. I'm utilizing the stock as collateral because I'm obligated to sell my shares at the strike price, in this case, our price target of 110, but I'm reducing my risk right here by $3.
Shifting it left there.
Yes, ever so slightly. Now, with options, there's a give and take. The give, of course, is this premium reduction of $3. The take is capped upwards potential. If I own the stock, I theoretically can hold it indefinitely. It can go up to an unlimited amount. Here, I'm capping my gain potential at 110.
All right, so limited upside, and again, we got the potential of 100% loss, but you've put some money in your pocket. We got about a minute to go here. We got lots of risks and also some rewards. Risks are leverage, complexity, time decay, and option. And I'm going to give you the floor here in a second. In terms of benefits, we got leverage, hedging, defined risk. What's the message? You got one message you could give options traders starting out. What is it?
Never hold an option till expiration. That's the worst thing you can do.
I've done this, by the way.
It's risk. If you hold the option, you lose giving up the time value. And then if you are short the option, then you actually have what's called gamma risk, and you have a huge issue of being unprofitable very quickly. So trade small, trade often, as they say at Tasty Trade.
Trade small, trade often. I really love that. Jessica Inskip, thank you for joining us. A new generation of retail traders is flocking to options trading as an alternative to plain vanilla stock investing. But the options arena can be complex to maneuver, and there are also pitfalls to avoid. So we're starting off with the basics in Yahoo Finance's Options Week 101. And this is sponsored by Tasty Trade. And now joining us to break this all down is Interactive Brokers Chief Strategist, Steve Sosnick. Steve, thank you for joining us here today. And let's start with a very simple definition here. This is a stock option definition, financial contract that grants the buyer the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified period of time. Just tell some of the important aspects of this for us.
Well, it's important to remember, Jared, that it is a right, and that's where the word option comes from, as opposed to, let's say, a futures contract or actually buying the stock where you're obligated to own that underlying security. As a result, the price tends to be lower, but the very important parts are you have to get that target price correct because there's a predetermined price, and you have to get the time frame correct. So there's a lot of it's much less of an outlay, but you really have to get everything just right for it to work out for you.
All right, with that, we have calls and we have puts. Calls are the right to buy a stock, put is the right to sell, but that's if you're long. If you're selling the stock, it's a little bit different matter. And for the newer investors, we're probably going to be thinking about buying calls or puts there, right?
Yeah, most people start off by buying options outright. There are a lot of people who do end up writing options, particularly covered calls. I know you'll get to that later.
We're gonna get to that tomorrow, actually.
No, I'm not gonna front run the next guest. But so what happens is, it's typical to think in terms of buying them to begin with. And again, it's a fairly limited outlay compared to the price of the stock usually to either speculate about whether it's going to go up over that period of time or whether it's going to go down depending on the contract.
Defined risk, a concept we're going to come back to. So the structure of a call option here, first of all, one option equals 100 shares, and then we have a couple different things. Maybe you can go through and outline the importance of each one of these things.
Yeah, so when you see the price of an option, you have to multiply that by 100. So if you see it trading at $1.50, your outlay is actually going to be $150 because it conveys the right to buy 100 shares. One contract buys 100 shares. The expiration date is predefined. So you're buying the March 190 calls on Apple.
Yeah,
so
there's
you have
weekly and monthly expirations there.
Even dailies for certain ETFs and index options. But we'll stick here to the weeklies and the monthlies for common stocks. But you do specify your date when you buy it, and you specify your strike.
Right there.
So the expiration date and the strike, and when you go to look at the quote, that gives you the premium.
And that's what you're paying if you're buying it.
Exactly. So you pay that premium. And especially if it's an out of the money option, meaning that if it's a call, the price is above the strike. The strike price is above the current price, or a put, the strike is below. That is pure premium. There is no intrinsic value to that option. It's just really what you're paying for the right to speculate on the stock price over that period of time.
So important to say that premium can just disappear 100%. That's something that you're just outlaying from the beginning there.
Premium does premium. There's few guarantees in options land. One of them will be that there is no premium left on expiration date.
Yes.
It's either going to be in the money or it's going to be out of the money, and this chart shows you that. So if,
we have first of all, this is for an Apple 190 call, and this is a typical profit and loss chart. So get used to this. We're going to be showing a lot of these, and in this example, this is the 190 strike, and it's $3.50 per share. But maybe you can try to break down the structure of this.
So if you're paying $3.50, so this little red line means that if it closes below 190, you lose all $3.50. You have to get it up and above 190, $3.50 for you to even break even. On the other hand, though, the advantage, the appeal of options is you could see how fast that line accelerates.
Right.
So if you get above that 190, $3.50 hurdle, the strike price plus the premium paid, that can accelerate very quickly, and that's the appeal that keeps people trading in options.
And another thing is, I look here, the red line, it never goes any lower. No matter how much the strike or how much Apple share price decreases, you're only going to lose that fixed amount.
That's true. It's very defined risk. The important thing, though, to keep in mind is most options expire worthless.
Yes.
So it is important to realize that
you're kind of giving that up in a lot of
instances. You are giving that up, and on average, it is speculation. And I think, unfortunately, some people treat it almost as gambling, and gamblers don't win most of the time. So you do want to use your defined risk, but you need to use it intelligently.
Yeah, good point there. The house tends to win, and that involves writing, but we're going to cover that later in the week. Yes. For now, just let's go through some of the benefits here, because we have leverage, hedging. We talked about defined risk, so maybe you could talk about leverage and hedging a little bit.
Well, sure. Well, the leverage part was in that graph before, because we mentioned that it needed to get past 193.50.
Right.
If you got to 197, well, that option is worth $7, and then you've doubled your money. So there's your leverage. So it's hit or miss to a certain extent, and when you hit, you can hit big. And that, I think, again, tends to be a little too appealing sometimes to people.
Yeah, we saw that in 2021.
Exactly. Hedging, on the other hand, tends to be if you're long a stock and you want to protect yourself on the downside, you may want to purchase a put. There are other ways to generate income, which again you'll get to with writing calls. That's hedging. And so the whole point of options was really not as a tool for speculation, but as a tool for risk management, to transfer risk and to allow hedging between different parties who wanted to, some wanted to assume risk, some wanted to lay off risk.
Very good. We got less than a minute, so we got to go over a couple of the risks here. Leverage can work for you, can work against you. Also, options are complex, and then time decay. We didn't talk much about that. Maybe you could just address time decay with a little bit of time.
Time decay is...
We're experiencing it now.
Time decay is one of the most unrelenting features of option trading. Well, as I mentioned, I can only guarantee you that there will be no premium on expiration, and that does dissipate as the time goes by. The longer you have for the trade to work out, the higher the premium of the option. As you get closer and closer, that premium declines. The risk, by the way, with trading very short-term options is that premium really decays very quickly. It's not linear. It's an exponential function. Sorry for getting too mathy,
That's all right.
but you fall off a cliff as you get close to expiration.
We really thank you for appearing on day one of Options 101 week here. Steve Sosnick, thank you.